Let me show you the exact moment most day traders lose. And it isn't when they're wrong, it's when they're right. And it still doesn't matter. They nail the direction. The chart does exactly what they predicted. They screenshot the win. They feel that sharp little surge of relief and pride, and the brain files it under, "I'm getting good at this." But the account balance quietly keeps bleeding. Not because they can't read a chart, not because they didn't want it enough, not because they need a better Discord group or one more indicator. They lose because, in the long run, they're playing a game that is structurally tilted against them, and they're calling it investing when it's something else. Benjamin Graham had a brutally clear line for this. He didn't care whether you were buying a blue chip, a penny stock, a bond, a commodity, or a can't-miss tech story. He cared about the process. An investment operation, Graham wrote, is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Read that again and notice what's missing. There's no mention of time frames, no mention of whether you hold for 5 minutes or 5 years. Graham isn't saying speculation is bad in some moral way. He's saying, don't confuse the two, because when you confuse them, you make decisions with the wrong tools, and you end up building a retirement plan on the emotional physics of a casino. So today, we're going to answer 2 questions with zero hype and zero guru fog. Why do most day traders lose, even some who are right a lot? And what does investment versus speculation actually mean in a world of zero DTE options, meme stocks, AI story stocks, and markets that feel like a 24/7 breaking news slot machine? By the end, you'll have a simple Graham-style test you can run on any trade idea, a checklist that protects you from the most expensive mistake. In modern markets, buying excitement while telling yourself you're buying value, because the real edge isn't speed, it's standards. Now, let's start with the part no one wants to hear, because it's not about emotions yet. It's about math and market structure, the stuff that silently eats accounts even when you trade well. Here's the uncomfortable truth. Day trading is a business with recurring tolls. You pay them every time you participate. People think commissions are zero now, so costs are gone. That's like saying air is free, so flying is free. The costs didn't disappear. They moved. They became quieter, more invisible, harder to feel on any single trade, and brutal when repeated hundreds, thousands, tens of thousands of times. The first toll is the bid-ask spread. When you look at a stock price, you're usually seeing a midpoint illusion. There's a price you can sell at right now, the bid, and a price you can buy at right now, the ask. The difference is a cost. It's the market's entrance fee. If you buy at the ask and sell at the bid, even if the last price hasn't moved, you can lose instantly before you were wrong about anything. In liquid mega cap ETFs, that spread might feel tiny. In smaller names, volatile names, meme stocks, low float movers, pre-market plays, it can be a chasm. Then there's slippage, the difference between the price you think you'll get and the price you actually get, especially when the market is moving fast and everyone is hitting the button at once. And then there's the fact that almost no one calculates their true trading cost correctly, because it doesn't show up as a neat line item called, "You got picked off by the market." It shows up as, "Why did I get filled there?" It shows up as, "It wicked me out." It shows up as, "That was manipulation." Sometimes it's not manipulation. Sometimes it's just, you're the slowest fish in a very fast pond. This is where the competition part matters. A lot of day traders still imagine they're playing chess against other regular people on their lunch break. You're not. In many of the most traded moments, earnings reaction, CPI prints, Fed press conferences, opening and closing auctions, you're competing with market makers and high-frequency systems designed to profit from micro movements, spreads, order flow, and speed. You're not fighting evil, you're fighting physics. If you're trading short-term, you're stepping onto a field where being slightly slower isn't a disadvantage. It's the business model. And this is why so many day traders experience something that feels supernatural. They feel like the market is watching them. They buy and it drops. They sell and it rises. They set a stop and price taps it like it had a map. What's really happening is more boring and more dangerous. When you place tight stops and chase momentum in crowded spots, you're putting your orders exactly where liquidity is hunting, not because anyone knows your account, but because humans behave similarly and markets adapt to clusters of behavior. The market doesn't need to know your name to know where your stop probably lives. Now add the next toll, turnover. Even if you're a talented short-term trader, frequent trading means frequent friction. That friction compounds against you. And then comes a toll that hits especially hard in the United States. This is not tax advice, it's just arithmetic. Most day trading gains are short-term capital gains, typically taxed at ordinary income rates. That means the IRS becomes your silent partner on the good days, while the bad days are still fully yours. Long-term investing, by contrast, often benefits from long-term capital gains rates, plus the massive structural advantage of retirement accounts, 401ks, Roth IRAs, where you can shelter compounding from annual tax drag. Here's a simple thought experiment. Imagine two people with the same skill, same starting capital, same market environment. One trades actively and ends up with a gross return that looks impressive on a monthly statement, but pays spreads, slippage, and short-term taxes along the way. The other buys a diversified set of businesses or broad market index funds, keeps costs low, and lets compounding breathe. Even if the day trader's gross return is higher, the net return can be lower. And the more you trade, the more the game becomes. Can you outrun the tolls? Most can't. Not because they're dumb, because the tolls are relentless. And here's the part almost nobody says out loud. If your strategy has a small edge, even a real edge, high turnover can turn it into no edge at all. You can be right in direction and still be wrong in outcome. That's why the moment most day traders lose is not when they guess wrong, it's when they guess right. But their process is still speculation, thin margin, tight time frame, high friction, and the math quietly wins. Now, if that was the whole story, we could stop here and say, don't day trade, the end. But that's not Graham. Graham didn't write to scold people. He wrote to protect them from themselves. Because even if you removed every mechanical cost, spreads were zero, taxes didn't exist, fills were perfect, most people would still lose. And that's because of the most expensive toll of all, your own nervous system. Graham's most powerful invention wasn't a formula, it was a character. Mr. Market. Mr. Market is your business partner who shows up every day offering to buy your share or sell you his share at a price. And the price he offers has very little to do with what the business is worth. It has everything to do with his mood. Some days, he's euphoric. He's convinced the future is a straight line up and to the right. He'll pay absurd prices for the story. Other days, he's depressed. He thinks the world is ending. He'll dump good businesses at prices that make no sense. Graham's advice was simple. Mr. Market is there to serve you, not to guide you. A defensive investor uses Mr. Market's moods as an opportunity. A speculator becomes Mr. Market's employee. Now think about what day trading does to your relationship with Mr. Market. It forces you to care about his mood changes minute by minute. It forces you to treat noise as signal. It turns your brain into a reaction machine. And the brain loves that at first because the reward system doesn't care whether you made a wise decision. It cares whether you got immediate feedback. Day trading is constant feedback. Win, dopamine, lose, cortisol, almost win, even more dopamine because I was so close. That's why people can get hooked on markets the way people get hooked on games. And that's why the average day trader doesn't just lose money. They lose attention, sleep, patience, and peace. They become allergic to boredom. But boredom is where real wealth is built. That's not a motivational quote. It's a structural reality. The stock market is a machine that transfers money from the impatient to the patient, but only if the patient is also disciplined. Graham called it being businesslike. Most people hear that and think it means being cold. It doesn't. It means having a process that doesn't require you to be a hero, because the worst trading losses aren't caused by lack of intelligence. They're caused by very human sequence. You win a few trades and become overconfident. You size up. You start feeling like you see the market. Then you take a hit. You feel the sting. You want it back. You trade again faster. Not because the setup is better, but because your emotions are louder. Then you take another hit. Now your brain is no longer optimizing for return. It's optimizing for relief. That's where revenge trading lives. And in that state, you can justify anything. You can call a gamble a calculated risk. You can call panic risk management. You can call a random candle a signal. This is why Graham's definition matters so much, because it forces a question that speculation hates. Where is the safety of principle? If you can't answer that, you're not investing. You're guessing. Now, at this point, someone usually says, okay, but there are profitable day traders. Yes, there are also profitable poker players. The existence of a few winners doesn't make it a good retirement plan for the average person. And Graham's audience, especially the defensive investor, was never the person chasing the thrill of being exceptional. It was the person trying to avoid being ruined, the person trying to build middle-class wealth, fund a future, retire with dignity, protect a family, and not have their financial life depend on being emotionally flawless in a market designed to exploit emotional flaws. That's who this channel is for. So here's the pivot. If not day trading, what is the Graham way to participate in markets, especially right now when everything feels speculative? When your feed is full of AI headlines, zero DTE options clips, I turned $500 into $50,000 reels, and story stocks that spike because a CEO said the right buzzword. Graham's answer begins with a distinction that changes everything. Price is what you pay. Value is what you get. And most modern speculation is the act of paying a price for a story without doing the work to estimate value. The story might be true. That's not the point. The point is, if you don't know what it's worth, you can't know whether the price is safe. You're relying on someone else to pay more later. That's speculation. Again, speculation is not evil. It's just a different activity. It belongs in the category of, I can afford to lose this and I'm choosing to take a risk. But what happens in real life is that people put retirement hopes into speculation while using the vocabulary of investing. They say, I'm investing in AI, when what they mean is, I'm buying a popular ticker and hoping momentum continues. They say, I'm investing in options, when what they mean is, I'm renting leverage for a short window and hoping volatility behaves. They say, I'm investing in this meme stock, when what they mean is, I'm joining a crowd and hoping to exit before the crowd changes its mind. Graham would call that what it is, speculative. And then he'd say, okay, if you're going to speculate, label it, size it, control it, but don't confuse it with your core plan. So what is the core plan? For the defensive investor, it's not about finding the next rocket. It's about building a portfolio that can survive bad decades, survive crashes, survive inflation scares, survive recessions, survive your own bad moods. That's what margin of safety really is. People often think margin of safety is just buying cheap stocks. It's bigger than that. Margin of safety is building your entire financial life with shock absorbers, like engineering a bridge that can handle weight you hope never shows up. In investing terms, margin of safety shows up in at least 4 places. 1. In what you pay relative to what you believe a business is worth. 2. In the strength of the balance sheet, the ability to endure hard times. 3. In diversification, not putting your future on one fragile bet. 4. In asset allocation, having bonds and cash when you actually need them, not when you feel like it. That last one is deeply unsexy, and that's why it works, because the market loves to sell you excitement, but it can't sell you discipline. You have to choose that. Now, let's make this practical in a way that respects the American viewer who's busy raising kids, working a job, maybe trying to max a 401k, maybe starting late, maybe starting small. You don't need a PhD. You need a process. Here's the process Graham would recognize, and I'll keep it simple. First, decide whether you are a defensive investor or an enterprising investor. A defensive investor wants safety, low cost, broad diversification, minimal mistakes. An enterprising investor is willing to do real analysis, read statements, value businesses, and act with discipline when prices are irrational. Most people, if they're honest, should be defensive for the bulk of their money, not because they're incapable, but because time and emotional bandwidth are real constraints. Your life is not a trading desk. Your life is a human schedule. Second, set an asset allocation you can actually live with. This is where the boring edge wins. Bonds, cash, rebalancing. Not because they make you rich overnight, because they prevent you from doing something catastrophic. In a crash, the biggest advantage of bonds and cash is not the return, it's behavior. It gives you a stable piece of the portfolio that lets you keep your head, and it gives you dry powder. The reason people blow up in crashes is not because they didn't know prices could fall, it's because they didn't have a plan for what they would do when prices fell. They thought they did. They didn't. You find out what your risk tolerance is when you're down 30% and the headlines are screaming. Third, keep costs low. This is the part nobody gets excited about, but it's a cheat code. Fees are guaranteed. Market returns are not. Every extra percent you pay in expense ratios, advisory fees, trading friction, that's compounding working against you. If your goal is retirement security, you should treat costs like a leak in the hull. Small leaks sink ships over long distance. Fourth, rebalance with discipline. Rebalancing is a mechanical way to buy low and sell high without needing to predict anything. When stocks run up, you trim back to your target. When stocks crash, you add back to your target. It's not glamorous, it's not viral, but it's deeply aligned with Graham's mindset, using Mr. Market's mood swings as a servant. Now, you might be thinking, okay, but what about picking individual stocks? What about intrinsic value? What about the Graham checklist? Great, let's talk about that, but in a way that doesn't turn into a math lecture. Graham's stock selection wasn't about being clever. It was about being safe. He looked for financial strength. He looked for a margin of safety. He looked for businesses that could survive. That means things like, is the company over-leveraged? Can it pay its bills? Does it have consistent earnings power? Is the price you're paying reasonable compared to normalized earnings? Are you paying for a business or paying for a dream? In modern terms, a lot of hot trades are dream priced. People ask, what if this becomes the next NVIDIA? That's not analysis. That's hope wearing a suit. Hope is not a valuation method. And yes, some of those dream priced stocks do become great companies. But the question Graham would ask is, at this price, is your principal protected? If the answer is no, then you can still buy it, but you must label it honestly, speculate. Now, here's the tool I promised. A simple Graham-style test you can run on anything: a day trade, an options play, a meme stock, an AI story stock, even a safe dividend name. 7 questions. If you can't answer them, you're not investing, you're guessing. Question 1. What is the source of your return? Is it dividends, earnings growth, asset value, or is it someone else will pay more soon? If it's primarily someone else will pay more soon, that's speculation. Question 2. What protects your principal if you're wrong? Not emotionally, mechanically. Do you have a margin of safety, a strong balance sheet behind you, a price that already assumes bad news? Or is your protection just a stop loss in a fast market? Stops are not a margin of safety. They're a hope that liquidity will be there when you need it. Question 3. Can you estimate intrinsic value even roughly? Not perfectly, roughly. If you can't even attempt a value range, you don't know whether the price is reasonable. Question 4. Do you understand the business like an owner? If you can't explain how it makes money, what drives its costs, and what could permanently impair it, you're not investing, you're trading symbols. Question 5. What are the frictions? Fees, spreads, slippage, taxes, option spreads, implied volatility. If you don't quantify frictions, you're ignoring gravity. Question 6. What is your time horizon? And is it compatible with reality? Not what you wish, reality. If you need the price to move tomorrow to validate the decision, Mr. Market owns you. If you can hold through volatility because value supports you, you own the decision. Question 7. If Mr. Market panics tomorrow, what is your plan? Do you add, hold, sell? Under what conditions? If the plan is, I'll feel it out, that's not a plan. That's a future emotional decision. Now notice, day trading can answer some of these questions, but it usually answers them in a fragile way. Source of return, short-term price movement, protection of principal, tight stop loss, intrinsic value, not needed. Time horizon, minutes to hours, plan for panic, often improvisation. It can work for a small percentage of people who treat it like a real business with real controls and who accept that it's speculation. But for most people, especially anyone trying to build retirement security, that framework is the wrong tool. It's like bringing a scalpel to build a house. A scalpel is powerful. It is also not how you build a house. So let's bring this back to real life. Imagine someone in their 30s, 40s, 50s. They've got a job, a family, bills. They want financial freedom, or at least financial stability. They want to retire without fear. They see day trading content and it's seductive because it promises control. It promises speed. It promises that you don't have to wait. But speed is not the same as progress. A lot of people don't lose to markets because they picked the wrong stocks. They lose because they picked the wrong game. They chose a game that requires constant emotional perfection to avoid ruin. Graham's philosophy is the opposite. It's built for imperfect humans. It assumes you will feel greed, you will feel fear, you will feel regret, you will feel envy. So it doesn't demand that you stop being human. It demands that you build a system that protects you when you are human. That's why defensive investing can look boring and still be the smartest approach for most people. Index funds, ETFs, broad diversification, low fees, consistent contributions, rebalancing, a reasonable bond allocation, some cash for stability. That's not laziness, that's engineering. And if you do want to add a small slice of individual stock picking, the enterprising side, then you do it with the Graham mindset. You insist on financial strength. You insist on a reasonable price relative to earnings power and asset. You insist on a margin of safety. You insist on being able to hold through volatility without being forced to sell. You treat it like buying a business, not chasing a chart. Now let's revisit the opening image, that day trader who won the trade. Here's what often happens next. They win again, or they lose. Either way, they're pulled deeper into the loop. The screen time rises. The emotional swings intensify. The trades multiply. The tolls multiply. The taxes multiply. The mistakes multiply. It's not just a money problem, it's a life problem, because the market becomes the center of gravity. And meanwhile, the boring path, the Graham path, quietly keeps working in the background. The person contributing to their 401k every paycheck. The person keeping fees low. The person rebalancing once or twice a year. The person using volatility as an opportunity, not as a threat. They don't get adrenaline, they get outcomes. And over a decade, 2 decades, 3 decades, outcomes beat adrenaline. So here's the core takeaway, as clean as I can make it. If you cannot explain the safety of your principal and the logic of your return before you buy, then you are not investing. You are speculating. And if you choose to speculate, do it consciously. Do it with a small, controlled amount. Do it like entertainment, not like a retirement plan. But if you want to build wealth the way Graham taught, wealth that can survive crashes, survive recessions, survive the noise, then you build around margin of safety. You build around emotional discipline. You build around price versus value. You build around a portfolio you can actually hold when Mr. Market gets hysterical. Because Mr. Market will get hysterical. He always does. And that's not a bug in markets. That's the feature that pays disciplined investors. One last thought to lock this in. The internet will always find a new story. It used to be .coms, then housing, then crypto, then meme stocks. Now it's AI and zero DTE options and whatever comes next. The characters change. The psychology doesn't. Graham's work survived because it wasn't written for a specific year. It was written for a specific human. The human who feels excitement at the top and fear at the bottom. If you can build a system that treats those feelings as weather, not as commands, you'll be ahead of most people for the rest of your investing life. And that's the real secret nobody sells, because it doesn't sound exciting. The real edge isn't a new indicator. It's not faster execution. It's not predicting the next candle. It's having standards strong enough to keep you out of the games that quietly destroy accounts. Margin of safety, low cost, diversification, a business-like mindset, and the humility to admit when something is speculation, even if it's popular, even if it's trending, even if it's wrapped in a great story. Because the market doesn't pay you for excitement, it pays you for being right in the only way that matters. Not on the screen today, but in your life 10 years from now. And if you want a simple action step after this video, here it is. Take the next trade idea you're tempted by, the next hot ticker, the next options play, the next everyone is talking about it stock, and run the 7 questions. If you can't answer them, label it honestly. Then decide whether it belongs in your serious money or in a small controlled speculation bucket. That one habit, that one line, can save you from years of noise. This is Benjamin Graham Investing, and Mr. Market will be back tomorrow with another price. Make sure you know whether you're buying a bargain, a mood,